Hello and welcome to Crisil Ratings podcast. I am Aditya Jhaver, Director, Large Corporate Ratings. In today's podcast, I would like to share the credit outlook for the capital goods sector, which includes equipment manufacturers and EPC players except road and civil construction. The sector is expected to see a healthy 16 to 18% revenue growth in the current fiscal before following up with a strong fiscal 24 at around 10 to 12% revenue growth, propelled by a strong order inflow on top of a already healthy order backlog. A closer look at the order book of player reveals a 9% expansion in the first half of the current fiscal on the back of a 14% expansion in fiscal 22 at an aggregate level. This has been primarily driven by higher commodity prices, rising government infrastructure spends, and steady improvement in private capital expenditure in consumption-based sectors. The recently announced fiscal budget focusing on higher government infrastructure outlays will also be a positive towards the sector. Higher order execution levels leading to better absorption of production and labor overheads, as well as softening prices of key raw materials like copper, aluminium and steel, especially in the last 7 to 8 months, is expected to lead to a 50 to 75 basis point expansion in operating profitability to over 10% in the current as well as in the next fiscal. While working capital requirements for the sector will rise, owing to the increase in scale, they are expected to remain steady in days terms in the current as well as the next fiscal. Furthermore, players in the sector have displayed a track record of prudent working capital management in the past as well. Credit profiles of capital good players are seen stable, supported by healthy cash accruals, strong balance sheet, and well-managed working capital cycle. With this, we come to an end to the podcast. Thank you for listening in and stay safe.